So, what are we diving into today? We're looking at a market that seems to be at war with itself. You've got this insane euphoria on one side and some pretty serious historic warning signs on the other. And the big question is, which one is going to give out first? Flipped is the perfect word here. It feels like just yesterday the market was all about caution, maybe even a little bit of fear. Now, it's like someone hit a switch. JP Morgan's pointing out that the buying is back, and it is back with a vengeance. So let's just dig into how wild this turnaround has really been. All right, first up, let's talk about the force that's really in the driver's seat right now. A wave of buying so intense, it is, and I mean this literally, a statistical freak of nature. Okay, so what does this plus 3Z thing actually mean? Well, JP Morgan's fancy tactical positioning monitor hit this number, and in plain English, that's what's called a 3 sigma event. It's something that should only happen about 0.3% of the time. Think of it like a 1 in 300-year flood, but for buying stocks. It's a massive, almost unheard-of wave of money rushing in. And here's the thing, this isn't just one group of people getting excited. Oh no, it is everybody. You've got the big systematic funds, the CTAs, they are piling back in. Retail investors, they just went on an 8-day buying binge, dropping more than $2 billion a day. The bears, they've completely thrown in the towel. And the really sophisticated funds, the long-short guys, have cranked their leverage way up. It's like everyone decided to press the go button all at the same time. Okay, so stocks are having the party of a lifetime. But there's this other, much older, kind of more serious part of the market that's singing a completely different song. And this is where the real conflict starts to take shape. And this really just lays it all out, doesn't it? On the left, you've got the stock market just screaming full steam ahead, pure euphoria. But on the right, you have the bond market, which a lot of people see as the smart money, and it is flashing some serious warning signs. It's a disconnect that is truly historic. I mean, just let that sink in for a second. We have to go all the way back to the dot-com era to find a time when stocks and bonds were telling such completely opposite stories about where the economy is headed. One of them is probably very, very wrong, and that's what makes this moment so fascinating. So here's the deal. Normally, you've got stock prices and bond yields doing this kind of dance together, right? There's a relationship there. But right now, the music has stopped, and they've gone in completely opposite directions. The S&P 500 is soaring, basically betting on a fantastic economy. Meanwhile, the 10-year Treasury is suggesting there's trouble on the horizon. This huge gap can't last forever. Eventually, one of these stories has to win. So that's the big question, right? If the bond market's so nervous, why is the stock market so confident? And it's really easy to just shout AI and call it a day, but when you actually look under the hood, there's some surprisingly solid stuff going on. Check this out. M&A, that's mergers and acquisitions, is a fantastic tell for corporate confidence. And right now, it is surging. Companies do not spend billions and billions of dollars buying each other unless they feel pretty good about the future. Just in tech, we're talking over $500 billion in deals. That is a massive vote of confidence from the people actually running these businesses. And it's not just the tech guys either. Look at the big banks. U.S. financial institutions are hitting new all-time highs. And think about it. When the banking system is this strong, it's like having a really solid foundation for the rest of the market to build on. All right, this next one sounds a little nerdy, but stick with me because it's super important. It's called the advanced decline line, which is just a fancy way of asking how many stocks are actually joining the party. And right now, that line has broken out to a new high. That tells us the rally is getting broader. It's not just a handful of giant companies pulling everything up. And historically, that's a really, really bullish sign. But come on, we have to talk about the elephant in the room, right? The main engine of this whole rally, artificial intelligence. And this is where things get, well, really interesting. And maybe a little paradoxical. So on one hand, you have the bull case. And man, is it a powerful one. You've got heavyweights like BlackRock saying this isn't just another tech trend. This is a fundamental revolution. They're talking about it being the mother of all breakouts, something that could totally rewrite the rules for economic growth. It's an intoxicating idea. Okay, but here's where the story takes a sharp turn. The costs are just mind-boggling. OpenAI, the company at the center of all this, is on track to burn through almost $500 billion by 2029. Let me say that again. $500 billion. We are in completely uncharted waters here. No company has ever lost money on this scale, which leads to the big question. How long can that possibly last? And it's not just the spending. The warning lights are blinking all over the dashboard. There's no obvious way for them to make money. Their user growth has stalled out in places like Europe, and they're just kind of throwing money at everything. Chips, robots, you name it. It feels a bit like a YOLO spending spree. And what's really interesting is that even retail investors seem a bit wary. They're buying AI stocks less than they usually do. And then there's this, the other half of the paradox. While the West is spending these astronomical amounts of money, a company in China called DeepSeek is already building world-class AI models for a tiny fraction of the cost. That puts immense pressure on everybody else. How can you ever be profitable when your competition can do what you do for pennies on the dollar? All right, let's pull back the lens for a second. Is this whole tug of war, this mix of crazy strength and deep contradictions, is this just a US thing? Absolutely not. We're seeing echoes of this all over the world. You look around and you see these bright spots you might not expect. South Korea's market, a huge indicator for global growth, it's on a tear. Over in Europe, the stocks that do well when the economy is good are crushing it. And get this, Germany's main stock index has basically kept up with the S&P 500. Not bad at all. But then you get to China, and oh boy, this might be the biggest head-scratcher of them all. You have the Chinese stock market, which looks like it's trying to start a big rally, happening at the exact same time that record amounts of money are fleeing the country. It just doesn't add up. So what do you do with that? Is it a giant red flag telling us this whole thing is a fake out? Or is this that moment of maximum pessimism, the darkest before the dawn moment, right before a huge comeback? And all of this brings us right here to the final section. It's time to lay all the cards on the table, because right now the market really is a battlefield between two very powerful and very different stories. All right, let's go to the tail of the tape. In the bullish corner, fighting for the rally, you've got that broadening market, you've got the M&A boom, strong banks, and bright spots around the world. But in the bearish corner, you have some heavy hitters. That historic warning from the bond market, the crazy levels of euphoria, the insane cash burn in AI, and all that money running out of China. So it all comes down to this. You've got this irresistible force of pure market mania crashing into this immovable object of historic economic warnings. Something's got to give. The only question for all of us right now is, which one breaks first?